The real challenge in going from saving to investing is not knowledge, it is trust. A lot of people think the hard part is learning the stock market, picking funds, understanding charts, figuring out where to put the money. But for most people, that is not actually where the friction starts. The real friction starts when money has been playing one role in your life for a very long time: protection. Because saving and investing are not the same thing at different intensity levels. They are two different jobs. Saving is about safety, investing is about growth. Saving is where money waits, investing is where money works, and a lot of people get stuck right between the two. Not because they are lazy, not because they are bad with money, and not because they are incapable of learning how investing works. They get stuck because they are still treating all of their money like its job is to protect them, which is completely understandable. If you grew up financially exposed, saving does not feel neutral. It feels emotional. Every dollar sitting in your account feels like proof that you are safer than you used to be. So the idea of moving some of that money out of visible cash and into investments can feel irresponsible, risky, even slightly insane. On paper, you know investing is how wealth grows, but emotionally, it can feel like letting go of the very thing that has been keeping you safe. That is why most people do not need more investing tips at first. They need a path, a clear step by step path that shows exactly when money should stay savings, when it should become investing, and how to make that transition without feeling like you are gambling with your future. Because once you understand the sequence, investing stops feeling like a leap and starts feeling like the next job your money was always supposed to take on. Hi, I'm Dan, and I spend way too much time thinking about how regular people can build real financial security without becoming boring, miserable, or obsessed with spreadsheets. If you're tired of feeling like everyone else got some secret lesson on money that you somehow missed, this video is for you. Meet Elena. Elena is 29, makes $61,000 a year, and has done something that already puts her ahead of a huge number of people. She saved money consistently enough to build a cash cushion. Not a giant one, but real money. Money that means her life no longer falls apart because of one surprise bill. And that should feel like a win. But instead, she feels stuck. Her money is sitting in savings. It is not doing nothing exactly, but it is not growing much either. She keeps hearing that she should invest. She knows inflation slowly eats cash. She knows rich people do not build wealth through a savings account. She knows all of that. Still, every time she thinks about moving money into investing, her brain throws up the same fear. What if I need it? That question traps people for years. Not because they are irrational, because they are mixing together two completely different jobs. That is the first thing you need to understand if you want to turn saving into investing. Money has jobs, and if you do not assign those jobs clearly, fear will assign them for you. Your emergency fund has one job: keep your life stable when life hits you hard. Your short-term money has a different job: pay for things you know are coming in the next few years. Your investing money has another job entirely: grow over a long enough time horizon that market fluctuations stop mattering more than compounding. When people say they want to start investing but feel nervous, what they usually mean is this: they are trying to send money into a long-term job before they have clearly funded the short-term jobs first. That is why the process feels chaotic. So here is the step-by-step path. Step 1. Build financial ground before you build financial growth. This is where almost everyone wants to skip ahead. Investing is more exciting than savings. It feels smarter, more ambitious, more adult. But if you start investing before you have any real cash buffer, the market can punish you at exactly the wrong moment. Imagine you invest aggressively, then your car breaks down, your rent jumps, or your job disappears during a market downturn. Now, you're forced to sell investments not because it is a good time, but because life cornered you. That is not investing. That is emergency liquidation. So before investing becomes your priority, your first goal is boring but powerful: build a real safety layer. For some people, that begins with a starter emergency fund. For others, it means building 1 month of expenses, then two, then three, depending on income stability, health, dependence, and how predictable life is. The exact number matters less than the function. The function is this: your life should not require selling investments to survive ordinary disruption. That is step one. Not because cash builds wealth best, because cash protects the part of wealth building that comes later. Elena learns this the hard way in miniature. At first, she thinks every spare dollar should go into investing immediately because she does not want to waste time. But then she realizes that one medium-sized problem would pull that money right back out. The issue is not whether investing is better than saving. The issue is whether the money is being asked to do the wrong job too early. Once she builds a stable cash cushion, something changes psychologically. Now investing no longer feels like releasing her safety. It feels like moving surplus money into a better assignment. That is step two. Define what counts as surplus. This is where people stay vague and then sabotage themselves. They say things like, "I will invest whatever is left over." Usually nothing is left over. Or if something is, it gets absorbed by random spending because unassigned money attracts consumption. So instead of waiting to see what happens, define surplus in advance. Surplus is the money left after four things are covered: your essential bills, your minimum debt obligations, your planned short-term expenses, and your emergency reserve target. Once those jobs are funded, the next dollars do not need to sit in idle protection mode. They can move into growth mode. That shift matters because it replaces emotional guessing with a rule. Elena stops asking, "Do I feel safe enough to invest this?" She starts asking, "Has this dollar already completed its safety job?" That is a much better question. And once the answer is yes, step three begins. Separate the buckets physically, not just mentally. This is one of the biggest reasons people fail to transition from saving to investing. They keep everything in one visual pile. One account, one balance, one emotional category. Then every dollar feels equally reachable and equally sacred. That creates confusion. Your money should not look like one blob. It should look like a system. One bucket is for immediate spending. One bucket is for emergency reserves. One bucket is for known medium-term goals. One bucket is for long-term investing. The reason this matters is simple. Money that sits together gets emotionally blurred together. When emergency cash and future wealth share the same visual space, you start protecting growth money like cash or risking cash like growth money. Both are mistakes. Elena creates separate containers. Her bills money stays where she pays from. Her emergency reserve sits in a high-yield savings account. Her travel and near-term goal money stays in cash because she may need it in the next couple of years. And the dollars beyond that start going somewhere new. Investments built for a much longer timeline. Now the transition becomes less dramatic. She is not putting her savings at risk. She is assigning one category of money to a completely different purpose. That brings us to step four. Understand the timeline before choosing the vehicle. This is where a lot of beginners get overwhelmed because they try to learn every possible investing option at once. Stocks, bonds, index funds, retirement accounts, taxable accounts, risk tolerance, diversification. Too much too fast. The simpler frame is this. The right place for money depends mainly on when you will need it. If you may need the money soon, cash matters more than growth. If you will need it in the middle distance, stability still matters a lot. If you will not need it for a decade or more, growth starts to matter much more than short-term volatility. That is why savings and investing are not enemies. They are timeline tools. Cash is for short-time horizons and safety. Investing is for long-time horizons and growth. Confusion only happens when people ignore the clock. Elena makes this concrete. She wants to replace her car in 2 years so that money does not belong in long-term investments. She wants financial independence decades from now. so that money does not belong sleeping in cash. Once she matches the money to the timeline, decisions stop feeling ideological and start feeling practical. That leads to step 5. Start small enough that consistency survives. This is where people sabotage themselves with intensity. They think becoming an investor means making a bold move, a large transfer, a dramatic identity shift, something impressive. Usually that backfires. A transition that is too aggressive creates panic the first time the market drops. Then the person pulls back, second guesses everything, and returns to cash emotionally bruised. The smarter approach is to start with an amount that feels almost boring, an amount small enough that you can keep going when headlines get ugly, an amount small enough that a market dip teaches you behavior, not terror. Elena begins with an automatic monthly contribution that does not strain her life. Not because small is ideal forever, but because durable beats dramatic. She is training a system, not performing confidence. That is an important principle in personal finance. The best investing plan is not the one that looks smartest on paper in a perfect year. It is the one you can continue through fear, boredom, bad headlines, and normal life. Which is why step 6 is automation. This is where saving becomes investing for real. Not when you read about investing, not when you open an account, not even when you make one transfer. It becomes real when the movement happens without needing your mood to cooperate. Automation is the bridge between good intentions and actual wealth. When Elena gets paid, part of her money now moves automatically into the right buckets. Bills. Emergency reserve if needed. Short-term goals. Investments. She decides the percentages once when she is calm, then lets the system execute when life gets noisy. That matters because manual investing feels optional every month. Automatic investing starts feeling normal, and normal is powerful. A lot of people think wealth is built through constant, high-quality financial decisions. Sometimes it is. But much more often, wealth is built by reducing the number of decisions required at all. That is what automation does. It lowers the number of moments when fear can interrupt the plan. Step 7. Expect emotional turbulence and do not mistake it for danger. This part is huge. The first time Elena sees her investments drop, even a little, she feels it in her body. Her savings account never did that to her. Savings is emotionally quiet. Investing is emotionally noisy, especially at first. That noise tricks beginners. They think volatility means something has gone wrong. Often it just means the money is now doing the job they assigned it to do in a real market instead of sitting still in cash. This is why the shift from saving to investing is not just financial. It is psychological. You are moving from visible stability to temporary fluctuation in exchange for long-term growth. That trade only works if you understand it before the drop arrives. Otherwise, every normal downturn feels like proof that cash was safer and investing was a mistake. But feels safer and builds more safety over decades are not always the same thing. That is the tension people have to grow through. Step 8. Keep increasing investment rate as safety expands. This is where the path gets exciting. At first, most extra money may need to strengthen your savings base. That is fine. But once your emergency reserve is solid and your short-term obligations are covered, future raises, bonuses, side income, and freed-up expenses can increasingly go toward investing. This is how the transition accelerates. At the beginning, saving dominates because fragility dominates. Later, investing dominates because stability has been established. Elena notices this shift after a year. Her emergency fund is healthier. Her monthly system is smoother. She no longer feels like one surprise expense will wreck everything. So when she gets a raise, she does not automatically inflate her lifestyle. She routes part of that increase straight into investing. Now, the machine starts to build momentum. And that momentum matters more than people think. Because once investing becomes a recurring function of your life, instead of a heroic act, your identity changes. You stop being someone who is trying to start investing. You become someone whose money naturally flows from survival to stability to growth. That is the real transition, not technical. behavioral. Now, there is one more mistake worth avoiding. Do not think the goal is to graduate from saving forever. That is not how healthy money works. You will always need some money in savings because life always has short-term demands. The point is not to abandon saving. The point is to stop asking savings to do investing's job and stop asking investing to do savings' job. Both matter. Both stay. But they serve different futures. Saving protects your present self from chaos. Investing builds your future self options. And once you respect that distinction, the path becomes clear. So, if you want the step-by-step version in plain English, here it is. First, make sure you are no longer financially exposed to every small emergency. Second, decide how much cash you actually need for safety and near-term goals. Third, define any money beyond that as growth money, not idle money. Fourth, separate your buckets so each dollar has a visible mission. Fifth, match the timeline to the tool instead of treating all money the same. Sixth, begin investing with an amount small enough to be consistent. Seventh, automate the process so behavior does not depend on motivation. Eighth, increase the investing flow as your safety base gets stronger. That is the path. Not flashy, not complicated, but powerful. Because turning saving into investing is really the moment your money stops being only a shield and starts becoming a worker. At first, money protects you from falling. Later, it helps you climb. And that is the shift most people are actually after. They do not just want a bigger account balance. They want money that creates options. Money that compounds while they sleep. Money that slowly reduces how much of life depends on constant effort. That does not begin with picking the perfect stock. It begins with understanding that each dollar has a stage of life. First, it must make you safe. Then, it must make you stable. Then, if protected long enough, it can begin making you wealthier. That is how saving turns into investing. Not all at once, not by force, by sequence, by clarity, by giving money the right job at the right time, and then letting the system carry more of the weight than your emotions do. That is the step-by-step path, and once you follow it, investing stops feeling like something reckless people do with extra cash. It starts feeling like the most natural next step a well-organized dollar can take.